investing in cryptocurrencies in the highly volatile market can be risky. Therefore, it's crucial to have a well-thought-out plan to navigate through this unpredictable market. A comprehensive investing plan involves in securing gains, managing risk, and knowing when to sell some or all of your position that you have appreciated since the initial investment. Hey guys, my name is Vincent Loo, and in this video, I'll share with you the essentials in cryptocurrency investment plan. First of all, we must understand cryptocurrency investment in Bitcoin and Altcoin. Bitcoin has a relatively large market cap. It's a well-established and recognized cryptocurrency, and everybody invests in it. It is now classified as a store of value assets. Click on this link above to know more about store of value assets in Bitcoin and in the description below. Altcoin, on the other hand, has a smaller market cap. As compared to Bitcoin, it is relatively smaller, hence is subject to higher volatility, offering potential rapid growth for investors. For risk-tolerant investors, this can lead to higher returns. However, investing in altcoins can be risky as the market has less liquid subject to more volatility. So stay alert. To invest in newly emerging altcoin in cryptocurrency, you must have a high tolerance for risk when dealing with these speculative and emerging technologies. These new altcoin new digital assets fall under the uncertainty regulations and numerous potential pitfalls. Crypto investors should never put in more money than they can afford to lose and remain mentally prepared for the possibilities of the altcoin to lose and go down in value and lose their entire investment. This harsh reality has been true since the creation of cryptocurrency. As we are still in the early stages, we must brace ourselves for unexpected developments in the coming months and years. Remember, this is not financial advice. Cryptocurrency such as altcoins remain a highly volatile market. So stay educated and be mentally prepared. To mitigate losing all of your investment in investing in the wrong altcoin, you need to do your own research. DYOR in short. It's not just a catchy acronym. It's a fundamental strategy that can make or break your investment. In this fast-paced altcoin cryptocurrency investment, relying solely on unspeople advice or tips can be risky. That's why it's crucial to take your time to thoroughly research on any projects or tokens or altcoins that you're considering investing in. Dive into their white papers, study the teams behind the projects, analyzing the market trends, and assess the technology and the potential use cases. By doing your own research, you'll gain a deeper understanding of these assets that you're investing in, by mitigating the risk and make more well-informed decisions tailored to your financial goals. And so remember, always DYOR before dive into the world of altcoin cryptocurrency investments. Now that you understand the theory behind investing in cryptocurrencies such as Bitcoin and altcoin, which is every other cryptocurrencies other than Bitcoins, now we have to understand trading part. So understanding paper profit versus realized gains. Taking profit means converting gains into actual profits by selling parts or all of your investment that have increased in value. When your cryptocurrency investment rise, the increased value remains theoretical until you sell them. That is called paper profit, as it's just unrealized gains and the numbers on the screen. Therefore, to profit investment, we must first sell our crypto and transfer it to a bank account, locking in those gains, making them real. That's why it's called realized gain. Do not try to time the market. Attempting to accurately predict the market peaks is unrealistic. For instance, when Bitcoin surged from 50k to 60k, where it reaches the previous peak, you might anticipate a correction and move everything to stablecoins, only to find that the market surged to 70k later, leaving you trapped with limited gains. So timing the market this way is very risky unless you are an experienced trader and have stayed at least one full crypto cycle. Instead of trying to time the market or sell everything at once, it is wiser to adopt a gradual exit strategy based on a predetermined plan, setting clear price point for selling your crypto and determining the percentage to sell at each target is a safer approach. Develop an investment plan. Creating an investment plan is crucial to make sure that you invest with strategies rather than emotions. This investment plan should outline which cryptocurrencies to sell and when to sell them, and what do you do with the profits. Do we reinvest the profits or cash out? Many investors dive into the world of cryptocurrency market without an investment plan, which is very risky. So here's an example of your investment plan. Let's say you purchase Bitcoin at 30K and you might decide to sell 20% at 50K and another 30% at 70K and so forth. So despite your emotions high and lows, you must ensure that you stay with these targets consistently and ensure strategic decision making, hence minimizing potential loss in gains. Short-term versus long-term strategies. Understanding your investment style is the key to success in cryptocurrency trading. Short-term strategies are like gambling, with potential for quick gains but high risk. Long-term strategies, on the other hand, involves with holding the investment for years, allowing a potential significant growth over the time, with less frequent trading. So let's talk about short-term tradings first. Aim for the gain. Set a targeted percentage increase at which you will sell your investment. For example, if you buy $50 worth of Dogecoin and set a targeted sell at 20% gain, you place a limit order at $60, which is 20%. So when the price rises from 50 to 60 and hits your limit order, then you gain a 20% gain. Aim for the gain strategy. The second short-term strategy is sales schedule. Instead of selling everything like aim for the gain, sales schedule is like selling portion of your holdings at a predetermined price points. For example, you bought Dogecoin at $50, you might sell 10% of your holdings when the price increases to $75, or 20% of your holdings when the price increases to $100, and so on. So you sell portion of your holdings and let the remaining ride the wave and increase, and then sell another portions for taking profits. So this is called sales schedule. The last short-term strategy is called house money. House money is where you withdraw your initial investment once it doubles up and let the remaining profits ride. Doing this might minimize the risk as you're only playing with the money that you gain, which is called house money. For example, you bought Dogecoin at $50, then the $50 value Dogecoin increased to 100%, which is $100. So now your investment 2x. For this 2x investment, you want to withdraw half of it, which is equivalent to the amount you put in the initial investment. Now that you have your initial investment amount, the remaining amount, which is called house money, will be used to do the remaining investment. So this is what we call house money investment. Combining these strategies can be even more effective. For example, after executing a house money strategy, you could implement a sales schedule on the remaining holdings. This way, the investment not only that is risk-free since you're only using the house money, you can also get a timely gains using sales schedule. So this is how you combine trading strategies together. In a bullish market where everything is going up, it's easy to overlook the possibility of a sudden change and turns to a bearish market. That's why establishing stop loss orders is essential to safeguard your investment. Just as you set exit targets for profit taking, it's crucial also to set exit strategies in place of a potential downturn. One popular approach is using the trailing stop loss strategy, where you set a percentage below current market price at which you sell your position. For example, you purchase an altcoin at $1 and set a trailing stop loss at about 10%. You sell all your holdings automatically if the price drops below 10%, which is 90 cents. Should the coin price rise to $2, the trailing stop loss will automatically adjust again with a 10% gap, which is $1.80, allowing you to secure gains while minimizing potential losses in the case of a sudden downturn. This enables you to gain on the bullish market while minimizing the risk when there's a sudden change to a bearish market. Now let's talk about long-term strategy. Long-term strategy involves in holding the investment for several years to capture large market movements like the Bitcoin halving cycle. I'll make one video on the Bitcoin 4 years halving cycle and how to take advantage of it later on. One of the important strategy in long-term strategy is called dollar cost averaging, DCA. So DCA is a strategy used by many investors to mitigate highly volatile market and reduce the risk of associating with timing the market. By using DCA, investor will have a fixed amount of capital to invest at regular intervals, regardless of the current price. This method spreads the purchase over the time, averaging out the cost of acquiring Bitcoin. By consistently investing over a period, investor can avoid trying to time the market highs and lows and potentially benefits from lower averaging purchase when the price goes down during a sudden downturn. So overall, DCA offers a disciplined and a less emotional approach to Bitcoin investment, promoting long-term wealth accumulation in a highly volatile market such as Bitcoin. Now that you know all about the strategies, let's talk about the tips for effective investment plan. So when you do your investment plan, you have to take in account of the transaction fee. Each transaction involves fee. Let's say you transfer crypto to fiat currency. Make sure you consider all these transaction costs in your investment plan. Another tip is called bank coordination. You have to inform your bank about large transactions to avoid your account from being freeze, and have multiple banks account to manage large profit withdrawals smoothly. And thirdly, exchange reliability. Exchange can suddenly experience outrage or delays, so it's wise to have multiple accounts across multiple platforms and keep the majority of your holdings in cold storage like crypto wallets. Regulatory risk. Cryptocurrency can be suddenly delisted by exchanges due to some regulatory actions. If your assets are targeted, you might have limited options to sell. So stay alert and well informed and prepare to act quickly. In conclusion, crafting an investment plan tailored to your investment goals and risk tolerance is essential. Whether it's short-term investment or long-term investment strategies or both, being well prepared and well informed will help you navigate through this volatile world of cryptocurrency market, effectively maximizing your cryptocurrency investment. If you like this video, please like, share, and subscribe, and I'll see you in the next one. Peace.